we go again. I'm Thomas, and in this video I'll cover why the market could be in trouble if summer goes too well. And for this, 3 particular macroeconomic data has to show a certain result. I'll make sure you will understand that, but before, let's see what happened this week. New CPI numbers came out from the United States, 4.9%, which is decreasing, so there is joy and happiness. Until we look at what this exactly means. Practically, food prices have skyrocketed, along with everything else except for energy. But if you look at this in percentage terms, there's a massive price increase in every single sector except for the energy sector. So just because energy prices have been artificially suppressed, which we will feel the effect later by the way, practically everything is running at a record high price, and inflation seems unstoppable, confirmed by another 0.4% core data. So inflation isn't really decreasing that much, but at least the CPI numbers are looking better. In addition, the United Kingdom raised interest rates by another 25 basis points, which met expectations. I'm waiting for future reports on possible tax increases, but until then, British banks are already panicking. And it seems that they are going down the same slope as American banks did in 2008 when liquidity issues started to give harsh environment for taking out loans. The latest move by British banks is to waive the down payment when taking out a mortgage. We already have a script for this, so we are nicely going down the hill. This can only be stopped if the BOE cuts interest rates to 0 within an eye blink, but there's less chance of this happening. And the best part of the week was the crypto market, because everything could be shorted on it. The pro server chat was buzzing, and I hope we will see a clear movement next week as well. So overall we had a very good week, and I hope the next one will be too, but let's see what can we expect from it. So we are starting with a relatively calm Monday with 2 important data. The Empire State Manufacturing Index, which will reflect the performance of production sector, and as we move into the summer period, it will be very important to see if it's increasing. If so, it will anger Jeremy Powell, but at the same time, this is the first point of data what needs to be completed if we want to see something very, very bad after the end of the summer. By the way, I would like to remind you that the Trade on the Market Macro Guidebook is being prepared, which will be a very extensive and advanced knowledge base with a very appealing appearance. It not only explains most of the important macro data, but also shows its specific impact on each sectors. It will be available free on the website, so keep an eye on the announcements on Discord server and in YouTube videos. There was also scheduled a monetary policy report hearings from the United Kingdom, from which we might learn more about the Bank of England's plan, as the situation is quite sad right now. The hearings has been delayed, but I'll share the info in advance on the Discord server, as it is really important. So, we have a high inflation environment, but it is currently being offset by a suppression of energy prices. In addition, interest rates have been raised for more than a year now, and to a very large extent for which everyone is waiting for the end. For this to happen, the economy needs to slow down so that we spend less. Thereby lowering inflation, the Fed can start cutting rates, everything collapses, then comes the money printing, Trump is elected again, and world peace is achieved. This would be a recipe, but if this data starts to rise before summer, as with all other PMI cases, the whole plan goes down the drain because higher production comes due to higher demand, which can be lethal in a high inflation environment. Last month we jumped to 10.8, which is scary. If we finish above 0 again, perhaps it's not tragic, but if we exceed 10.8, we will be discussing the possibility of stagflation. This predicts a longer period of interest rate hikes, which could ruin the credit system and banks and basically everything. However, this forecast is also related to the expected pressure on stocks and currencies. And this is point 1 in today's conclusion. But going forward, there is a Tuesday where we will need to pay attention for more things. There is a monetary policy meeting coming from Australia, which will affect the volatility of the Australian dollar at the time of the meeting. I will explain how on Discord. The UK claimant count change, which measures the number of people applying for unemployment benefits, and the average hourly earnings index from the same region is also coming. So the British pound will be quite jumpy because on the top of all of this, there is an unemployment rate coming too. Then Canadian CPI numbers for measuring inflation, followed by American retail sales, which is the second conclusion point. In terms of currencies, we will have a busy day and a busy week, but it's not a problem, at least there will be some opportunities. So first of all, in the United Kingdom, the number of applicants for unemployment benefit has been increased steadily since July 2021. Last month, we were at 28.2k, so again above zero. This is the increase in the number of applicants for benefits, which is an extra problem for the kingdom, as their goal is no longer to slow down fully the economy, but, on the contrary, to fight to maintain it. Therefore, the rising data can have a particularly negative impact on the BXY chart, so it will be worth paying attention to this announcement. We can hope for a strong DXY day, in which case we can get a really weakening BXY. So chicken soup recipe is ready. However, if the data decreases, this scenario may not happen. And so there will be another data, as I said, the average hourly earnings, but we're going to focusing on the next one. Lastly, from the UK on this day, we have the unemployment rate, which has been increasing since October last year, with some months of stagnation, of course. The latest data was 3.8%, which is not a drastic number, but the trend of increasing does not suggest a good direction. High unemployment would be bad news for the Brits now, contrary to everyone else in the world, because they would starve to death, actually. Therefore, in case of further increase, it may happen that the Bank of England will be among the first to attempt pivoting and cut interest rates so that stimulus can come, but alongside this, inflation will run away, so tax increases could also come. From the BXY's perspective, everything under 3.8% is good, but everything above it is tragic. And so let's see the second point. In the United States, retail sales data have always had a significant impact on the currency exchange rate, and it is one of the most important predictors of GDP. Car sales are excluded from the core data calculation as they tend to fluctuate and can significantly influence the overall retail sale number. The main retail sales data are published monthly by the United States Census Bureau, and the previous month's data fell below zero again. Specifically, it dropped to minus 0.8%, which is good news, so the rate of sales is slowing even without car sales. All this is nice and calm, but the market is extremely attentive to this data. Indeed, if it starts to increase in the middle of a summer holiday rush, it would also mean GDP growth, which is almost a seal on stagflation. Therefore, in the case of an increase, both the core and the plain data, the DXY may react positively due to the expectedly rising GDP, but in the long term, it will have very negative effects. The threshold value is 1.4%, and anything above this is considered significant activity. The forecast itself is 0.5%, which is not tragic, not too high, but it already signals something happening. So, as I said, this is the second conclusion point for today. Please remember for that. And now let's moving for the next day. Wednesday will belong to the European Union because apart from the Australian price index data, EU CPI data will coming in, and I will be very exciting to see if there will be hidden inflation here as well, just like in the United States. But to be honest, I don't need to over-detail this data as I did so many times, and we are currently at 7.0%, which doesn't tell the whole picture as we know about the core data. Last month I detailed how important the potential convergence of core and plain CPI data is, and I also hinted that some sinking in the plain data is still expected for now. The market also expects this, so in case of a disappointment, crying may come, and in the case of data arriving based on calculations, instead of rejoicing, we can sweat further. Because the strong DXY performance of recent days has put considerable pressure on the euro, so even a small disappointment could have a big impact on the value of the euro. Let's not forget that we have a serious MACD divergence on the euro index chart, so this is the EXY. So in case of strong dollar, the outlook is quite good for next week for us forex traders. And now let's move for the next one, which is Thursday. On this day, we are back to Australia, so we need to keep a close eye on the Australian dollar. Perhaps this will finally stabilize the direction of the index. Since the USD is very dominant, I would be very happy with that. So we will receive employment data from the land of kangaroos, then unemployment data from the United States, and staying here, another manufacturing index. That means we won't be bored at all. First of all, important information is already coming from Australia at the beginning of the week, as I said before. In addition, they are also doing very well in terms of employment at the global level, for now at least. If the policy meeting mentions the possibility of pivot and these data do not improve, we will try to be smart. Specifically, we won't try to test the possible strong AXY against the DXY, but against much weaker index. In this case, if the British data turns out to be disappointing, it could be a perfect choice for a currency pair. For this data, anything above 20k is considered good, but we also need the unemployment rate to be positive, which data will be released right after that. But we're gonna have a look now. The third point for our conclusion today. Our data from last week was 264k, which began to indicate the result of layoffs with serious increase. The value is now at a threshold. Above this could be considered damaging to the economy, which in this case it is, and somehow this is the goal. So the situation remains unchanged. The increase in itself doesn't support the strong DXY, but it is good news for the Fed and for us too if we want a quick Fed pivot. The decline would reflect the summer preparation, which means inflation. And that means many more interest rate hikes and weaker DXY. So this is the third point of conclusion today. Please don't forget, and I'll let you know what I mean under that. But before I do that, let's see the next day, which is the last day of the week. However, Friday will have less data with the two Canadian retail sales. But, and this is very important, at 5 p.m. Eastern European time, Jeremy Powell will give a speech during which we should expect significant volume. Of course, as always, but not necessarily for the same reason as we did so far. After this, we can get back onto the crypto market over the weekend, but before we do, let me explain why it is so important and different. Powell's speech is always important. We used to see reactions due to interest rate hikes comments from him, but this time it might be different. Everyone is now starting to understand and accept that the Fed will go on with the interest rate hikes as necessary. They said this for an entire year, but human is just human. Don't hear, don't listen, but saying it is money printing and QE generates a lot more views on YouTube, so many of us don't hesitate to publish absolutely no sense information. There is no QE, no money printing. All of this is just a fairy tale. Well, will come, that's for sure, but later on. However, there is something else now, and because of this, everyone expects Powell to hint at something. This is the raising or not raising the US debt ceiling. As the deadline is June 1st, some panic is starting to build due to the bad scenario, which we also sensed on the DXY chart on Thursday and Friday. I still believe that the debt ceiling will be raised. However, the market might panic a bit, so anything that Powell hints on this day will move the US dollar. And now see, what do we have for this week and what do we think about the summer and the end of the summer? So we have touched upon 3 concluding points. The first one relates to manufacturing index data, specifically highlighted the Empire State Manufacturing Index. Its significance lies in the considerable danger of an increase. Many are anticipating a Fed pivot by the end of the summer, and this is actually not impossible. However, it can only happen if inflation is successfully brought down. If producer data begins to rise, it sets off an avalanche, with the cause of the avalanche being summer vacation and spending. Alongside increased producer data, we must therefore start focusing on the next 2 sets of data. The first of these, our second concluding point today, which is the retail sales. If retail sales rise alongside increasing manufacturing index, it signifies preparation for the summer surge, and increased sales could have a slight impact on GDP. If this scenario unfolds, we can move on to the third concluding point, which is unemployment claims. Compared to the previous two, this can signal a trouble later by indicating a decrease in the number of people applying for unemployment benefits after the increased manufacturing and retail sales data. The unemployment rate will be also important at this point as a fourth point what we didn't mention now. If all three scenarios come true, a Fed pivot at the end of the summer becomes completely impossible. And since it will almost certainly lead to a significant increase in inflation, it is questionable whether it will happen at all in this year. If not, then there is a major problem because the banks will face even greater pressure due to continuous interest rate hikes, causing them to tighten credit conditions further, which is already very painful. This will result in a massive damage, and when the pivot finally arrives, it will shatter everything. So, not a good insight, but something to watch. And now comes the interesting part of today's video, another interesting part, as an interesting situation has arisen in every sector. Starting with the stock market, we observed that in the world of major indexes and ETFs, almost all of them delivered slightly weak performances. The S&P 500 did not plummet, but it has been consolidating with a range for a whole month now. However, the Dow Jones suffered surprisingly significant losses, while the Russell, although it stalled around 1,720 level, has been steadily declining over the past 3 weeks. The iShares Global Real Estate ETF, representing the real estate market, is consolidating within a bearish flag, but it experienced losses throughout last week. The Copper Miners ETF also closed the week with considerable losses. On the other hand, the Nasdaq showed quiet positive movement this week, raising the question of what is happening here. Now, if we look at the stocks, all the stocks in the US market, even the larger cap stocks showed small improvements in weekly performance, if they did any. This pace of improvement was not able to produce positive returns on any index because smaller cap stocks came under significant selling pressure. However, there is one stock that performed remarkably well, and that is Google. Since there was a high call percentage in the options contract this week, but no significant limit was set, the main reason for the current strength of the Nasdaq is Google. This serves as a warning sign that if Google even slightly turns to south, negative pressure could strengthen on all indexes and the Nasdaq may experience a temporary reversal. As there was no standout favorite stock this week, this could be a fortune period where we receive such a clear signal for the upcoming week. Therefore, it will definitely be worth keeping an eye on the movement of Google as an indicator. The initial panic reaction coming from the failure to raise the US debt ceiling were quite evident on the DXY chart during the last 2 trading days of the week, as I mentioned before. As a result, the euro experienced a significant drop, nearly reaching the support level at 108.43. This level is considered strong, but if it breaks, its message will be powerful. The Japanese are trying to maintain the yen, but they can do little against the pressure from the US dollar. As I have indicated numerous times on Discord, one of the biggest losers in the event of a strengthening DXY is likely to be the British pound, and indeed it suffered the 2 worst days. Additionally, the New Zealand dollar, Canadian dollar, Swiss franc and Australian dollar all bled during these days. This could present a great opportunity in the coming week if the strengthening of the US dollar becomes a sustained trend, as it represents the dominant currency above all. However, we should not forget that even a trend is built with corrections, so the strategy should be chosen accordingly based on the desired time frame to trade on the selected chart. We will dive into this in more details on the Discord Pro server, by the way. However, the easiest market in this week was the crypto market. Everything closed in red, and we experienced a strong capital outflow which provided excellent shorting opportunities, and it was a real bloodbath, but it is more evident on the total chart. And don't let anyone say that we didn't anticipate it, because we have been monitoring the head and shoulders pattern for weeks now. It has now broken below the neckline and touched the 200 EMA level before the cycle closure. And the cycle closure is 14th of May, by the way. I could show you numerous charts, and I assume the similar result, not surprising. Safe short scalps could be executed on charts with higher volume. So for now, there are no signs of momentum reversal in most cases, but we are monitoring it continuously. So we received direction and strange, and there was joy and happiness in it. I hope it's gonna stay for the next week. And I also hope the information was useful for you. Remember, at the pro level, we analyze every major macro data and draw the proper conclusions when they arrive. If you want to join, visit our website, link in the description. In the meantime, I would love to hear your thoughts and opinions, so please use the comment section for that. If you want to stay informed about next week's data or other useful information, subscribe and turn on all notifications. And if you enjoyed the video, give us a thumbs up so it can reach more people. And for now, see you in the next video.